Today, we're talking about mortgage rates and loan products. Hey everyone, it's Dave Meyer, and you're listening to On the Market. And a couple months ago, we had a very popular episode talking to three very experienced lenders, Chaley Ridge, Kenny Simpson, and Crystal Moore. And because this was so helpful to our audience in navigating the confusing lending market right now, we decided to bring them back on to discuss what's going on in the lending world as we're about halfway through the year. Kenny, Crystal, Chaley, welcome back to the show. Thanks for being here again.
My pleasure. Good to see you.
Thanks for having us.
But Crystal, how does this compare to commercial rates? What are you seeing?
So commercial rates are really around mid sixes. It's kind of the same scenario depending on the deal size and location. Pricing might vary slightly, but assuming like $1 million minimum loan amount, we're pretty much 6.5 to 6.6 right now, which is why a lot of the like 2 to 4 guys are trying to buy apartments right now because the interest rates are better.
Yeah, that does make a lot of sense. Do you think we'll see rate relief in 2024?
Well, I think we were all thinking back then, and I think we now know that there is a lot of money in the system and it just hasn't got out, right? I mean, we do know that Powell has a very tough job too. I think he wants to cut rates, but he's also does not want to do it prematurely, even though some of us would agree that maybe he should. But I think he's very focused on the jobs. Jobs. I think, unfortunately, he doesn't want to come out and say it, but he wants to see people lose jobs, which would create, probably some type of sort of slowdown in consumer spending more than there is now. And so until we probably see either some craziness happen or the consumer fall off a cliff or some pain in jobs, meaning probably over a 4% mark, I think we're not going to get the cuts and we're going to see rates kind of maintain. The good news about rates, which I will say, is the 10-year, the difference between the 10-year and the 30-year fix, that spread was at 3.10. That's actually come down to 2.60. So the rates would be higher if it wasn't for that. So we did get some relief. So I'm going to celebrate there a little bit.
Crystal, let's move to you. Are you in agreement? You think we'll have a little bit of rate relief, or are you more optimistic?
I do think that we'll have some rate relief as long as the trend continues. Of course, that's why we've seen some reduction of treasuries in the last week or so. But definitely, I think we're seeing that credit card delinquencies are going up. The jobs numbers didn't come in as good. Inflation came in slightly below expectations. So if we continue to have these reports going forward, then I do think that we'll see rate relief. It might not be as much as we had hoped in the beginning of the year, but I do feel that we'll see some relief. For sure.
The other thing is rents are now becoming flat to negative. That growth stopped. Things like car insurance peaking, that's not going to peak every year. So when you look at the inflation reports and the jobs report, you start breaking it apart and dissecting it, which a normal person's not. You're seeing pain. It just, like you just said, we're probably 90 days out to really start to see that effect. And if the trend continues, it'll be good news for mortgage rates and, investors and home buyers. What's really out there, what I'm seeing, a lot of HELOCs, an overwhelming amount of HELOCs, which is unfortunately could spur inflation because people have spent their money, they tap the credit cards, and now we're on HELOCs because there's a lot of equity.
Interesting.
I'm also seeing a lot of fix and flips. A lot of people are actually doing construction loans. They want to, if they can't, they're knocking stuff down here, they're buying. And the other thing is a lot of non-QM, DSCRs, things like that. So because of these regional banks and all the issues, which will continue to problem because they're going to have balance sheet issues, which Crystal can talk to you about on the commercial side, I think the non-QM market's going to, as long as it remains healthy and fluid, that's going to be a big help for a lot of investors that are going to need that product where they can't get it at a regional bank or a big bank.
I'm surprised a little bit by the HELOC, because aren't HELOC rates like 9% right now? I looked recently and they're super high, right?
I'm telling you, there's a lot of HELOCs going on, like a lot.
And it's also a much lower interest rate, surprisingly, than their credit cards.
That's a good point. If you're using it for expenses or certain, rehabs, then you should be comparing it to a credit card or a bridge loan instead of to a primary mortgage.
And you only pay on what you draw. So that's
Right.
that other thing where we've used that too for investors who are maybe looking to buy a property and they haven't quite identified that yet. The HELOC is a great way to do it because you only pay when you draw on those funds.
Yeah, I'm a fan.
Crystal, I did want to turn to the commercial side because, there's been a lot of focus, not just with real estate investors. It seems like the broader media has been very focused on lending and the state of commercial paper. Can you just tell us what you're seeing here in the commercial side of things?
Yeah, I wish I had a rosy picture to paint, but lenders generally are being much more selective on what deals they're doing. I'm seeing lenders are controlling their volume. Even though rates have come down over the last week or so, they're still keeping spreads a little bit higher. And it's mainly because there's these kind of like this looming rules for banks to have increased reserves. And so they're really trying to beef up their balance sheet. And they need some of these payoffs that were at 3 or 3.5% to fall off their balance sheet. They're also scaling way back on interest only right now. So interest only is much tougher to get right now because auditors are coming into the banks and telling them that they have too much interest only on their books and that they need to keep it within a certain ratio. So I'm seeing a huge reduction in that across the board. But yeah, with investors, people are still trying to make deals work. So I see that most people are looking to buy deals where you can add ADUs. That is a big play right now. And even though I mentioned earlier that the 2 to 4 unit investors are trying to make the jump to commercial, what they're seeing when they do that is that I'm telling them they have to put down, 50, 60% on an apartment purchase. So then they go back to the other side to the 2 to 4 where they can add ADUs or play that game a little easier with way less down.
Yeah, it's easy to say, look at commercial rates, they're a little bit less. But then when you see the LTV requirements and how difficult it is to even find someone who's willing to lend to you right now, it might not be as attractive, I think, as any experienced commercial operator might tell you.
Yes.
Just out of curiosity, Crystal, you mentioned that auditors were cautioning banks against more interest only. I've never heard of that. Why would an auditor care about that? Or why are banks held to some specific ratio on interest only versus fully amortized loans or balloon loans, partially amortized?
Primarily because of all the rollover, right? So when I talk to a couple of my banks, they're anticipating 2025 to be a really big year, at least as far as refinances go. But the problem is if you had your interest rate fixed, like for example, I have one of mine that's fixed at 3.1% with interest only for 5 years. If when I go to refinance, my rate is 6.5%, I'm not going to be able to afford that mortgage. Now, for me, I say we need interest only more than ever because of that reason. But auditors say that this is putting the banks in a bad position to possibly have non-performing loans. So they're not going to, I don't even know if they will